So P8-30A, it says quality recliner chairs completed the following selected transactions, and they give us a bunch of transactions. And I like to eyeball it real quick. It looks like they're listing the transaction at the top of each entry field where you put in the answer. So I don't think we really need to have this open. I'll close that and let's see. We sold inventory to Gray Mart, receiving a $38,000 9-month 8% note. Ignore cost of goods sold. Okay, so what they want us to focus on is recording the note. So we're going to have, and be careful, don't select accounts receivable, because in this case it's a note receivable from Gray Mart. Okay, and then we have sales. So we got sales revenue. So this is a $38,000 9-month note receivable. And another indicator that it's a note receivable is that we're going to actually be charging interest on it. So it has an 8% interest rate. Does that make sense? Yeah. So instead of accounts receivable, we're using another asset called notes receivable. Okay? And we're leaving this thing out for 9 months. So normally an accounts receivable would be collected within a month, I would say. I mean, it might be senseless to let those receivables stay out there longer than that. So I guess in this case, if the customer wanted to have a longer term to pay, then what we're saying is, okay, that's fine, but we're going to charge you 8% interest. So we're going to call it a note receivable versus an accounts receivable that we would want to turn over quicker, right? We probably would want to get it in 15 days if we could, okay? Depending on what industry you're in and where you're at in the market. I mean, if you're a small player, then your buyers can demand the terms, or they can be real forceful and say, well, we want 45 days kind of thing. But, you know, if you have more weight in that market, then maybe you can demand shorter terms, right? If, like, I don't want to say you're a monopoly, but maybe you're one of only a few, then, you know, you're in high demand. You can say, well, you're going to pay me quicker, or I'm not going to do business with you. Okay. Now we're going to we recorded a credit and debit card sales for the period. Oh, wait, for the period of 18,000. So use the gross method. We're going to collect all. We're going to show all of it, right? So let's see. Where is my? Let's make sure we're doing that right. Remember, we had our book open. Oh, we lost it, right? We closed the book. Okay. Should be okay. Okay. Just remember, in the gross method, you don't show the credit card expense in that first entry. You're going to show it later when technically when the bank draws it out of your account. Okay. Okay, now this is when the bank's going to draw it out, right? Card processor drafted company's checking account for processing fee of $400, right? So they drafted our account. They went ahead and pulled the money out of our bank account. So we're going to charge this to the credit card expense, and we're going to reduce cash, 400. And then if you're curious, and I'm a little curious just in general, so I kind of want to do this, and it's not part of the problem, but I'm going to take 400 and divide it by 18,000. So it looks like we're paying 2.22% to the credit card company. So for every sale we make, the discount fee, that's what they call it, the discount fee that we pay back to the credit card company is 2.2%. Okay. So you know American Express is close to 4%, like 3.98, and MasterCard and Visa are down lower than that, 2.3 or in that area. A lot of times that's why businesses say we don't accept American Express, is because they got to pay a higher percentage back, right? Okay. Okay, made an adjusting entry to accrue interest on the Gray Mart note, right? right? So let's see. We issued the Gray Mart note on July 1st, and now it's December 31st. Okay, you see Gray Mart July 1st, December 31st. I would probably use my fingers if it's not clear enough, right? So all of July, August, September, October, November, and December. 6 months have gone by. Okay, so we have a 9-month note. Right, so you got, the way you do it is you take time, right? Remember, we go time times interest times rate equals the interest, right? If you want to do it linearly like that, right? So the time is 6 months have gone by out of 12 months. Even though it's a 9-month note, that 8% is an annual rate, right? APR, annual rate. Okay, so we're going to express our time in terms of a year. So that 6 months out of a 12-month year have gone by at an annual interest rate of 8%. And I made a boo-boo over here, right? We'll call this principal, right? So 6 months out of 12, right? Principal is $38,000. That's initially what the note was for. And the rate is 8%. Okay? So if we do that math, and 6 over 12 is a half, right? And a half of 8% is 4%. So technically, you could really break it down real quickly in your head. 4% times 38,000. So the interest is going to be 1,520. We have to accrue that, right? So we're going to have a interest receivable debited, and we're going to have an interest revenue credited. Okay, so interest receivable and interest revenue. And I said 1520. Okay, so that captures 6 months out of the 9 months on that note. It's a 9-month note. Okay. Now we made an adjusting entry to record bad debt expense based on an aging of accounts receivable. So what they did is they went ahead and did that whole aging exercise for us, right? The aging schedule shows that 13,800 of accounts receivable will not be collected. That's the estimate of what will not be collected. Okay. Prior to this adjustment, the credit balance in allowance for bad debts was 11,600. Okay, and we're using the allowance method. So why don't we diagram it, and we'll take advantage of the time to really explain what's happening here. If I had a T account, and it might look like this, and this would be my allowance for bad debt. Okay? And what they're saying is, prior to making the adjustment, right? They're saying that the balance should be 13,800, right? This is what we need the adjusted balance to be, right? This is what's needed in the account, okay? But prior to that, we're showing a balance of 11,600. Okay, so we got to make a journal entry to bring this unadjusted balance up to 13,800. Okay, and the entry would be to debit, and I'll do it over here, debit bad debt expense and credit the allowance for bad debts. Okay, for the difference, for the amount that would bring this up to that 13,800. So all you really have to do is take the difference, 13,800 right? And this would be the adjustment. Okay? So we'll drop that 2,200 in there. Did that make sense to everybody? Right? So we're always adjusting into the required balance. And then we'll make a note over here, right? The required balance is generally obtained from the aging schedule. Or we'll call it accounts receivable aging schedule. Okay? Like we did earlier with the percentages, right?
Can you show me how you got 15 and 20 in the previous?
15, 20, we took the principal. So we're backing up, right? The principal is 38,000 because that's the amount that we have out there we're waiting to collect. Okay? And that was done on July 1st. So from July 1st to the date that we need to make the adjustment on, which is December 31st, that's 6 full months. Okay? So I'm going to take 6 divided by 12 because that's the time, that's the fraction of time that went by. 6 out of 12 months. And I'm going to multiply it by the principal and then multiply it by the, it's an annual percentage rate. That's why we have to use 12 months. Even though it's a 9-month note, the interest rate is expressed in an annual percentage rate. Sometimes you see that on your, how many have a car loan? Or any kind of loan, right? Sometimes they call it APR, okay? So if I multiply those three, I get 1520. And I did it real quickly in my head. Basically, I said, you know, 6 over 12 is 1/2. And you could either go a half of 38,000, or I went a half of 8%, and then that's 4% times 38,000. If you want to reduce it that way, right? That's how we got it. And then the journal entry is just to show that you're waiting to collect that interest. You haven't collected it yet, but you earned it because the time went by, right? The gray had your money for 6 months, so you technically earned that interest. Okay. Everybody okay on the allowance that we did down here? Yeah, we're always adjusting into that balance. Okay, let's see what else we got. Okay, now on April 1st, we're collecting the maturity value of the gray note. Right? So remember, it was issued on July 1st. July, August, September, October, November, December. On December, we accrued interest for 6 months. Right? December, January, February, March. Because April 1st is, the month of April hasn't gone by yet. So we can only count through March. That's 9 months. Okay? We accrued 6 months worth of interest. So what's going to happen is we're going to make a collection, right? And the first thing we're going to collect, we're collecting all of this at the same time, but if you want to think in logical order here, we're going to collect the gray marked note receivable, the principal. We're going to collect 38,000, right? And if you have to scroll back up to remember, that's fine, because that's the note receivable, 38,000. So we're getting our money back. We're getting the 38,000 back. Okay. The second thing, if you want to think chronologically here, is we're going to collect the interest that we accrued, right? So we got to collect the interest receivable, which was 1520. See, we accrued that on December 31st. So 1520, right? And then finally, we're going to collect the last 4 months or the last 3 months worth of interest, because we've accrued 6 months and it's a 9-month note, so we're going to collect interest revenue for the last 3 months. And we could use the same formula. If you want to do something like this, you could go 3 divided by 12 times 38,000 times 8%, and that would give you the last 3 months, right? So you could go 3 over 12 is 1/4, right? So you go 0.25 times 38,000 times 0.08. You're going to collect 760. Now there's an easier way to do it, right? What you could do, right? Can anyone, I know some of you are sharp math people beyond any math I ever have taken, but I'll show you a real quick way. You could have just computed the total interest on the whole note, right? So you just take 8% and do it over here. 8% times 38,000, right? If you did that and then you subtracted from that total, you subtracted what you already accrued. So you already accrued 1520. Okay, that'll tell you how much you have for those remaining 3 months. Let's see if that gives us the same 760 that we worked out over here. We'll just go 0.08 times 38,000 minus 1520. Can I hit an underscore over here? Wait. My math is off. You know what we didn't do? We got to put in the time factor, right? So times 9 over 12 because it's 9 months, right? So if you do that, that should give you the 760. Okay. So you could do it that way, or you could just go ahead and compute the last 3 months of it. Time is a very important thing you got to pay attention to. So let's see. If we're collecting all of that, then we need to add all of that up, right? So real quickly, I'll take 38,000 plus 1520 plus 760. So we're going to be collecting a full 40,280. Okay? You guys okay with that? Yeah.
Why are they paying the extra interest if they paid it off in the 6 months?
They didn't pay it off in 6 months. We accrued, right? If you look at the 6 month mark here, we accrued 6 months worth, but we never received the payment. See,
So it's just for the record.
well, we earned it, so we gotta, the reason we do that on December 31st is we need to get this interest revenue into 2013. That revenue belongs in 2013 because
Okay.
we earned it in 2013, but we didn't collect it in 2013. We're collecting it when the note matures, which is at the end of the 9 months.
Oh, okay.
So down here when we collect it, see how it's going away, right? It's getting credited.
Yeah.
It's going to be part of that cash collection, right? Now we only had accrued 6 months worth. Another 3 months was earned up through April 1st. So that's why this is going directly to interest revenue. We don't have to accrue it because it's going to get paid on that date. Okay. So combine this credit to interest receivable of 1520 and the 760 in interest revenue ends up being what the total interest revenue is for the whole notes, for the term of the note. Okay, that's the full amount. It's just at what point we choose to recognize the interest revenue. And we got to use that matching principle and make sure that the revenue is recognized in the period that it's earned in, right? And the 1520, the 1520 is the portion that was earned in 2013. And then 760 is the amount that was earned in 2014. We're assuming an annual accounting period, calendar year. Okay. And you know, technically we probably would do it every month. We probably would make an accrual every month. Okay. What do we have next? We sold merchandise to Artist Corp, receiving a 60-day 12% note for $7,000. So we're going to go note receivable, Artist Corp, and sales revenue, and that's going to be a $7,000 right? We're just recording a sale, but because it's going to be charging interest and it's 60 days is a little longer than what a normal accounts receivable would be, we're going to put it in notes receivable. Okay. Now it says Artist Corp dishonored its note at maturity. The business converted the maturity value of the note to an accounts receivable. Okay, so what we need to do is we need to figure out the maturity value. So we're going to need to figure out the interest, right? So it's a 60-day note. For academia, we're going to use a 360-day year. Okay? So don't get thrown off by that. The year really has 365 or 366 days. But I'm going to take my 60-day note and divide it by a 360-day year. It keeps it nice and clean, nice and even, right? 1/6. And we can go ahead and multiply that by the principal and then by the rate. And the rate is 12%. So that's going to give us the interest. Okay. So $140. So again, if you kind of confused on this, this is time, and you can move them around in any order you want because of that mathematical rule. What is it called? A times B times C is the same as C times A times B. Who took math recently? Some one of those theorems. I'm not going to be on record here acting like I know the name of the theorem, but you can move that thing around any way you want when you're multiplying. So I did time times principal times rate, and that gave me interest. Yeah. So they're dishonoring the note, and they're going to convert it into a accounts receivable. So we're going to move the principal, which is the note receivable from artists, the 7,000, along with the interest revenue, and we're going to recognize it as interest revenue, and we're going to lump all of that into an accounts receivable, which is going to be due a lot quicker than a notes receivable. Questions on that one? So if you look at it, right, initially we had a note receivable. They dishonored it. They're saying, well, we can't pay. Okay? We can't pay on the date that it's due. So they get rid of that. We're going to work with them to try to get payment. We're going to take away that note receivable and make it an accounts receivable. But that accounts receivable is going to be for both what the accounts receivable principal amount was and any interest that we had earned through that date. So that's why it's $7,140. Okay. Okay, now we make a direct loan. We loan $21,000 cash to Crow Inc., receiving a 90-day 16% note. Pretty straightforward. We'll have a note receivable from Crow, right? And we're going to just reduce our cash. So we're not earning any kind of revenue when we lend the money, right? It's not being generated from a sale. It's just a straight loan. So we're loaning out $21,000. Our cash balance goes down, but another asset called note receivable increases, showing that this Crow company owes us $21,000. Okay? That's the principal amount, $21,000. Questions? Okay, good. Now we collect the full amount from Artist Corp. So we got multiple things going on. You want to pay attention to the names. Artist Corp owes us $7,140. So if I collect that, I'm going to debit cash, and I'm going to credit accounts receivable Artist Corp. That's this guy right here, $7,140. Okay, now we get down to December 31st of 2014, and it says we need to accrue interest on the Crow Inc. note. So I'm going to go back up here. Okay, we recorded the Crow Inc. note on November 16th. Okay, and now it is December 31st. Okay, so on November 16th, we had a note receivable debit and a credit to cash. I'm kind of redoing it here, right? And this note was to be at 16%, right? So 16% rate, and the principal is $21,000. Now we got to think about how much time went by. Well, technically, it's a 90-day note. Half of November went by, right? Because we issued it on November 16th, so the second half of November elapsed, if you want to use that word. And then all of December went by, because we're all the way down here on December 31st. Okay, so a month and a half, right? A month and a half. You could say 45 days out of 360, right? Whatever fraction you want to use, and we're going to probably try that. We could try 45 days out of 360, okay? Or you could go 16% times 21,000 times a month and a half, so 1.5 divided by 12 months. I think either one would work. Why don't we try this one? So if I go 21,000 times 45 divided by 360 times my rate of 16%. I don't have it in the exact same order. Maybe I should have done it in the order I show up there. So 16% times 45, well, times 21,000 times the fraction of the year. Right? 16% times 21,000 times 45 divided by 360. I get 420. Why don't we try this one? So we'll just change one of the factors, and we'll make that 1.5 divided by 12, 420. Okay? So your time is going to make the difference in what you come out with, right? So a month and a half went by. We have to accrue interest, so we're going to have interest receivable and interest revenue of 420. Okay? Go back. So interest equals principal times rate times time. That's kind of what this problem is driving home for you. Let's see here.